Hi, good morning. Thanks for joining us for our Monday morning call. Today's agenda will involve Adobe, Keppel Corporation, and Keppel Infrastructure Trusts, and we'll cover whether REITs are still attractive, and ending with Singapore Weekly Week 14. So without further ado, we'll move on into to Ambrish, who covers Adobe.
Thanks, Timothy. Good morning, everyone. Adobe reported its first quarter results in the last week of March amid the challenging macroeconomic environment. Next slide, please. The results were in line with revenue and PATMI at 24% and 25% of our FY 2022 forecasts. Sorry. Moving on to the positives, Document Cloud continues to be Adobe's fastest growing segment. The Document Cloud segment revenue grew by 17% year on year to $562 million, and annualized recurring revenue for Document Cloud segment climbed to $2 billion. The main growth drivers were strong demand for PDF solutions due to paper to digital transition and the year-over-year increase in e-sign transactions within Acrobat. Secondly, Adobe reported gross margin of 88% and operating margin of 37%, both were flat year over year. The margins mainly benefited from lower travel and facilities spending amid a peak in Omicron cases in December and January. Lastly, Adobe has disclosed its intention to increase pricing for its Creative Cloud products in May. This is likely to boost Creative Cloud revenues in the second half of 2022 as price hikes takes effect at renewal for existing customers and for new customers. Adobe believes that it has delivered significant value to customers by introducing various products and through platform innovations, including Creative Cloud Express and Frame.io offerings. The company has not provided any further specifics, and the last price increase was announced in 2017. In terms of negatives, Adobe has stopped selling its products and services in Russia and Belarus in response to Russia's invasion of Ukraine. The war is expected to impact digital media annualized recurring revenue by about 87 million, which consists of 71 million with respect to Russia and Belarus region and an additional 12 million pertaining to Ukraine. The company further estimates that its FY 2022 revenue is likely to be hit by about 75 million due to these adjustments. And secondly, company's tax rate increased to 18%. This is mainly because of lower than expected tax benefits related to stock-based compensation. In second quarter, the company expects that its tax rate is further expected to increase to 20%. And assuming that everything else is constant, the increased tax rate is expected to hit its earnings per share by about 6% every quarter. Let us now move on to the outlook. The outlook still looks, the company is expected to generate stable growth through the rest of the FY 2022. In the second quarter, the company has provided a guidance of earnings per share of $2.44 per share and total revenue of 4.34 billion. This represents a revenue growth of about 13% year on year. And the net new digital media annualized recurring revenue is expected to be at $440 million. Adobe did not provide an update to its prior FY 2022 guidance. During 4Q21 earnings call, the company had guided earnings of $10.25 per share on total revenue of $17.9 billion for FY 22. And the two segments, digital media and digital experience segment, they are expected to report a revenue growth of about 14% each. Finally, we have reduced our PATMI for FY 2022 by 2% due to the business disruption impact associated with the Russia's invasion of Ukraine. And as a result, our DCF target price has been reduced to 602, which is an upside of about 30% from its current stock price. And I would now like to pass on to Natalie for the discussion of REITs. Thank you.
Good morning, everyone. Thank you, Ambrish. I'll be talking a little bit about this segment that I presented for the SGX Trading Day, and it's entitled "Are REITs Still Attractive?" Okay, next slide, please. Okay, so in the graph on the left-hand side, this is what you're looking. What we're looking at right now is the light blue line, which is the 10-2 spread, which is the 10-year and 2-year spread, and also the dark blue line, which is the FTSE REIT index. So basically, it's the price performance of the REITs. So we can see that, in looking back at history, we observe that, in periods where we see a declining, in periods where we see the yield spread declining, which is pointing downwards in the areas shaded in pink color, that is when we see the share price for the REITs actually rally. So towards the right-hand side of the graph, which is where we are right now, 2022, we can see that the yield curve is actually narrowing. So this could actually mean that there could be a potential rally for the REITs. Okay. And of course, so when this chart starts to point downwards, that is one of the reasons could be because of the short rates that are actually rising. So that means that it's a more flatter yield curve, and that means that while higher interest rates, although they are a headwind for the REITs, we think that there are three reasons why supporting the REITs. First of all, of course, it would be the higher as REITs employ a relatively high average interest rate hedge, around 70% on average, but it ranges REIT to REIT, as a range about 50% to 100%. Second of all, there are three sectors, namely the office, retail, and hospitality, that are still trading at depressed levels because they're still recovering from the pandemic. So we can expect further uplift from relaxation of restrictions as well as the reopening of borders. And thirdly, of course, the REITs. In the years of 2020 and 2021, the REITs have been very active at rebalancing their portfolio. In fact, the REITs made about 13 billion in acquisitions in 2021. So of these acquisitions, they not only help to diversify the REIT, but also have to strengthen the portfolio and, of course, increase, hasten DPE recovery. Okay. Next slide, please. So in terms of valuations, how are we looking in terms of valuations? On the left-hand side, we see the forward dividend yield spread. So when the blue line is actually below the red line, that means that dividend yields are actually trading below average, below historical average. And also that also means it's a little bit on the expensive side. Currently, for the forward dividend yield spread, it's at negative 1.4 standard deviation level. And on the right-hand side, we look at the price to NAV. So the higher the price to NAV above the red color line, that means that the more expensive the REITs are trading compared to history. So at this level, the REITs are actually trading at 0.9 standard deviation levels away from the mean. So overall, valuations appear a little bit elevated. However, next slide, please. However, we still do see some value. Or rather, we still see some value in some subsectors. Namely, they are the blue area on the chart, which is the stable performers, and also to a certain extent the overseas REITs. Okay, so in this graph, what we're looking at right now on the left-hand side, the y-axis, that's the DPU yield. So this is of course based on a consensus estimate, the DPU yield for FY22, and on the x-axis, what we're looking at is the DPU growth. So at the far right on the right axis, you can see the boxed up in green is the reopening place. So this is where you see some of the retail REITs as well as the hospitality REITs. They're still recovering, and hence, DPUs are growing at a faster level, a higher level. And then moving to the left-hand side of the screen, for the overseas REITs, they generally do trade at a higher DPU yield. This is because there's more risk attached to overseas REITs where we cannot see the quality of their assets. And right below the overseas REITs, we actually see what is the most comprising in the blue box, mostly the overseas as well as the industrial kind of REITs. And these the overseas and the industrial REITs, especially the industrial REITs, they have been relatively shielded from the pandemic. Most of them actually provided DPU yields in FY21 very close to what pre-pandemic DPU yields were. So overall, the DPU yield is relatively decent if you're looking at the counters within this blue box, but yet there's still some DPU growth, between 1 to 10% if you're looking at the blue box. So this is where we find the most value in terms of trading close to, rather giving dividends close to pre-pandemic levels, as well as possible upside from DPU growth. And this DPU growth, of course, is due to AEIs as well as the acquisitions that these REITs have been actively embarking on in 2021. In terms of subsectors, we think that the industrial and the retail subsectors they are still our preference. For the industrial subsector, they carry assets such as logistic, high-spec data centers, as well as business parks. And these asset classes are termed sort of the new economy assets, in the sense where they are able to capture tenant demand from new economy tenants, such as your tech companies, your biomedical companies, your life sciences kind of companies, engineering kind of companies. And these companies are benefiting from secular growth or also structural growth, and hence are able to command or able to afford better rents. Another thing for the Singapore industrial REITs or the Singapore industrial market is that after many years of declining rents, we finally in 2021 we saw that the rents actually bottomed out and have started to provide positive rental reversions. So that is a positive for the industrial REITs. In terms of for the retail, retail obviously is a very immediate beneficiary of the relaxation of the measures that were announced on the 28th of March. This will of course help to some of the measurements that were announced during the most recent announcement was, first of all, the increase of group size from 5 to 10, including for dining customers, the resumption of atrium sales. Yeah. And all of this will of course help to lift, bring in more footfall for the shopping malls, as well as the higher kind of tenant sales. In terms of preferences, we do prefer the suburban malls over downtown malls, and this is due to, of course, early recovery for suburban malls. So some of the downtown malls, such as your VivoCity, your Paragon, they're still very much dependent on tourism spending. However, of course, we do not think that it will still take some time for tourists to return back to our shores. So if you look at the graph on the left-hand side, there are some laggards that are actually on the left-hand side of the graph, being like OEE, CT, SPH REIT, MCT, and also some of the names like Suntec and Star Hill Global. So these REITs, they do have typically, in terms of tenant sales or rather footfall, about 30% of the footfall actually comes from tourists. Yeah, and of course, as we know, the tourism numbers are still very depressed, the international visitor arrivals. In terms of office, we are starting to be a bit more positive on the office subsector. The supply is somewhere slightly above the historical 5-year average, but still relatively manageable. And also, as more employees return back to the office, we think that will help with leasing momentum. As you know, when you go back to the office, then the management is able to better evaluate how much space the company needs or requires, and then that will help to spur the leasing conversations. There's another potential catalyst for the office subsector, which is the removal of stock for redevelopment potential. Yeah, and so that could help to reduce the office stock. In terms of the last subsector, which is the hospitality, we're neutral on this subsector, mainly because the valuations have actually run ahead of the recovery. We still believe that it will take some time for the sector to return to pre-pandemic levels, likely only to happen in 2023, but more likely in 2024. So, but the market has already priced in this recovery, although DPUs are not expected to recover back to pre-pandemic levels until the next 2 years. Catalysts for this sector, of course, are more countries relaxing travel restrictions, as well as an increased willingness to travel. But I do want to point out that within the sector, we like escort residence trust. I mean, you say that amongst, although we're neutral on our hospitality sector, there is an exception, which is escort residence trust, and largely due to the more stable nature of their portfolio, as well as a 16% exposure to extended stay assets, which has a long, more income visibility and stability, high occupancy. Yeah. So I think that's all from me. I'll now hand the time over to Terence.
Thanks. Good morning, everyone. We published our report on Keppel Corporation, which together with Sembcorp Marine announced another delay to the potential combination of their two O&M units. In our next slide, Keppel Corp and Sembcorp Marine announced that while significant progress has been made on advancing the proposed combination, including mutual due diligence, the transaction structure, the exchange ratio, and other related matters, they will still need more time to reach the definitive agreement. Both parties remain committed to continue with exclusive negotiations with each other and have targeted to reach a definitive agreement by the 30th of April 2022. Separately, Keppel T&T has announced that they have entered into a divestment agreement for their loss-making logistics unit for a total consideration of about $80 million. In terms of some of the positives, in the same announcement, Keppel announced significant progress made on advancing the sale of its Keppel O&M's legacy REITs and associated receivables. Recall that the sale of the O&M legacy REITs and associated receivables into Asset Co, along with the planned merger of KOM and Sembcorp Marine, are two separate deals that are running concurrently. And the sale of these legacy REITs and associated receivables are interconditional, and both must pass in order for the deal to progress. The announced divestment of its logistics business, which is loss-making, will also move the group closer to its 15% ROE target. The entity has been loss-making for FY21, even though management guided that the logistics business saw a booming year. They still reported a loss after tax for FY21 at $5.2 million. In our next slide, in terms of the negatives, this is the second delay to the potential combination of KOM and Sem Marine. We are naturally concerned that there's a second delay, because this is the second delay that they announced. But we also note that this extension is just 1 month away. So we think that this means that some of the due transactions, like the exchange ratio and the final terms, that it's just being, they just need 1 month to agree upon them. If they announce a 3-month delay, then we think that there are more unresolved issues. But given that it's just 1 month away, we are less concerned about about them not meeting the terms of the transaction. In terms of the outlook, the chapter on SPH is now closed. That is a positive. We think while the arbitration is ongoing, this will not derail the SPH demerger. So the main catalyst that we are looking out for is that for Keppel is the proposed merger of its O&M, the divestment of it. The successful divestment of their logistics business is also expected to be positive for the group. The outlook of the oil and gas industry is also improving, underpinned by firm oil prices. In our last slide, we maintain a buy recommendation on Keppel with an unchanged sum of the parts target price of $7.07. We value Keppel based on the 4 new segments that they have to better reflect their reporting segments going forward. So the 4 main segments are on the table on your left: energy and environment, urban development, connectivity, and asset management. That's all for me on Keppel. Our next coverage is on Keppel infrastructure on Phillip on the ground. Just to note, we don't have any coverage on Keppel infrastructure, and this is just a Phillip on the ground. So there's some background on Keppel Infrastructure Trust. KIT have 3 main business segments. They are in the distribution and network space. They are in the energy segment and the waste and water. In the distribution and network space, one of their biggest segment is City Energy, or another name for it is City Gas. City Gas is the sole producer and retailer of pipe down gas. So this is for some users, this is the natural gas that you use at home when you cook. So they have about 870,000 commercial and residential customers. The primary source of cash flow is based on the per unit of gas sold, with fuel and electricity costs passed through to consumers. So they don't bear any of the risk from the natural gas costs. Ixom is newly acquired, is their new industrial infrastructure business in Australia and New Zealand, and this supplies and distribute key water treatment chemicals as well as industrial and specialty chemical. It's a leader in their field and has been proven to be economically resilient as well, and recession proof as well. And then the other key highlight is this new acquisition that they did recently. It's Aramco Gas Pipeline Company, where they hold a 20-year lease and leaseback agreement over the usage rights of Aramco's gas pipeline. So the way that management mitigate risk for Aramco is they have quarterly payments that is backed by a minimum volume commitment from Aramco. So every quarter they know that there's at least this minimum volume that they will definitely have to produce from the gas pipeline. The key risk though is if they're only able to, it's a demand issue, is if they're only able to meet the minimum volume and not have anything more than this. I'll just go a little bit faster. For the energy and waste and water, it can be a little bit complicated for those who are a little bit new to this sector. But the way that to understand this is, for this energy and waste and water treatment plants, is we don't have to be concerned about the volume or the amount, the throughput that they process, because these are actually just fixed payments for meeting availability targets. It's a bit different from the Aramco one. Aramco, there's a little bit of a demand for the gas pipeline at play here. So naturally, higher demand for the gas, you will see better cash flows and earnings. But for this energy and waste and water, it's actually just fixed payments. So as long as the plant is available, they will receive a fixed payout. They just need to make sure that their plants are running. There'll be some downtime, so that's what we're watching out for also for maintenance. But other than those downtimes, those scheduled downtimes, they will be able to receive fixed payments for the plant. In our next slide, KIT is embarking on a new growth phase, and they have proposed fee amendments to enhance the alignment with unit holders' interest and drive portfolio growth. What KIT is doing is to align fee structure with the long-term value creation of the group. So on the left-hand side, you can see this table here that we have. This is the current fee structure of KIT. You see here the existing management fee is fixed at $2 million per annum. In terms of performance fee, this is 4.5% per annum of the trust income. The acquisition and divestment fee at 0.5% and 1% of the investment acquired or divested respectively is generally quite standard with the industry. Under the proposed fee structure, the group is proposing to change the base fee to 10% per annum of the distributable income by the group. And the performance fee will also be changed to be 25% per annum of the increase in DPU multiplied by the weighted average number of units in issue. So for us, what this new proposed fee structure does is to better align management's management strategy with the shareholders, because they will be compensated based on the increase in DPU here. When we look at the DPU for KIT, the DPU has actually been stagnant for the last 5 years. In fact, there's no change in DPU since 2016. Of course, in 2021, they upped the DPU slightly in the second half of 2021. But otherwise, the DPU is almost like a bond, so it's quite stagnant. But with this proposed performance fee, what the management team has guided is that they will have to be more aggressive in growing DPU, as contrast to the old KIT, where they're just happy to pay the shareholders a fixed unit. And then also no change to the acquisition. We just have one more point. The proposed fee structure is the 10% and 25% here is actually largely in line with how the rest of the market is charging. In our next slide, KIT also separately announced a strategic review of Ixom, which they acquired in 2019. Management reviewed that the strategic review was triggered after they received a few unsolicited bids for Ixom. Since the acquisition in 2019, it has provided roughly $60 million in cash flows to KIT per annum. So the Ixom, according to management, has proven to be both recession-proof and also has the ability to deliver stable cash flows to the group. Should the divestment occur, though, the deal pipeline is strong and robust, and management has guided that they will reinvest the proceeds from the divestment of Ixom into new acquisitions that they are currently looking at. And there shouldn't be any reduction in the DPU that they provide to unit holders, even if they divest Ixom. So that's all from me from KIT. I'll now hand over the time to Paul for the Singapore.
Thanks, Terence. Move on to the next slide. In terms of some of the macro highlights in Singapore, we have a RevPAR for hotel industry. Just a refresh, RevPAR refers to occupancy rate times the room rate. So you can assume RevPAR for hotels is like the sales, because it's occupancy, or utilization times the price. So in February, the RevPAR in Singapore was about $117, and it's actually up 77%. So that's very strong. It remains below pandemic, but this is very encouraging because this happened in February, and this is even before the reopening on the 29th of March. So you can expect even stronger RevPAR growth as we enter into April and so forth. Likewise, we saw similar inflow of passengers in Changi. The headline numbers is strong, is 5x up year on year, but compared to pre-pandemic, it is still really like 85% below pre-pandemic levels. We had some numbers on property. HDB resale price continued to be healthy, although it's still the slowest in 6 quarters. So the pricing is important because it gives avenue for HDB upgraders into the private residential market. Meanwhile, for residential prices, it was only up 0.4. It's the slowest quarter-on-quarter growth in 7 quarters, as to be expected, I guess, with the recent cooling measures. In the US, we had some very good payroll numbers or employment numbers. You can see it's up 400,000. Even the prior February was also up 750,000. And the unemployment is, 40, 50-year kind of lows. In the EU, they got a spike in inflation again. And this is inflation in the EU is the all-time high. And this is, curiously, this is even though we have got 8 years of negative interest rates. So some some ECB officials have already come out to the market saying that they are not surprised if they're going to raise rates by the end of this year. They are already stopping bond purchases, or their version of quantitative easing. Technically, the buzz around the headlines everywhere or the news cycle now is all about the yield curve. We'll show you more details on the charts later, but even if you assume 18 months lag, because typically it's about 16 months lag before you get the first yield curve inversion to recession. So even though we don't think our base case is a recession, but even if recession is not imminent, but it will still signal a major weakness in the US economy, likely 3rd or 4th quarter of next year. We still like the interest rate cycle theme and stocks like banks. right now the market even expects the Fed rate to hike to end the year at end December 22 at 2.4%. So this means that you can assume not 100 basis points in your assumption in terms of interest rate, but you should assume 200 basis points increase in interest rates as the base case. So very likely the Fed was going to raise rates by 50 basis points. And like we mentioned, even the ECB that has like very hesitant to raise rates is also looking to lift off. That's the exact words, possibly in end of this quarter. In terms of some of the macro news coming up, sorry, the 29 March is a typo, but you might get our Singapore GDP number, I think maybe Thursday or Friday. They don't give a specific date, they just give a few days, but it could come out on Thursday. And the other one is FOMC minutes on the 6th that will probably give you some signals of them undergoing quantitative tightening. In terms of our webinars, on Friday we have Comwell REIT. So I guess the interest will be following the impact of the Ukraine conflict, how is it affecting some of their properties, even those in Poland. So if you're interested, do dial in for that. And also, the unique thing about Cromwell is that a lot of their rents are linked to CPI, which, as we just mentioned, in Europe is like record highs. On Saturday, we'll have our usually quarterly presentation, so do sign up for that if you have the time. Likewise, on the following Thursday, on the 14th of April, is it Thursday? On the following of 14th of April, we will have our US team talking about big tech strategy. Next slide. So this is the much talked about yield curve. So just bear with me in case some do not know what it means by inversion. So this is basically your 10-year bond interest rate less the 2 years. I mean, to avoid complexity, just assume this is like a 10-year FD versus the 2-year FD. So usually, if you put money for 10 years in an FD, I'm just giving an example. You obviously want a higher interest rate because once you lock in the money, you're going to face a lot of risk, volatility, inflation, and so forth. But inversion means that your 10-year FD is actually below the 2-year FD. I mean, just to give you, so it's a bit strange. Right? Why would people want to put that? So it assumes that interest rates are going to come down. So why is this so important? Is that it has been a very good predictor. It doesn't cause a recession. It's not because the yield curve invert, which that means it go negative. That means the 10-year is lower than the 2-year that recession happens. So if you look at this chart, whenever there's an inversion, it usually there's I'm using monthly average. So usually a recession happens between 10 to 22 months. Average about 16. So that's why the market is a bit nervous whenever there's an inversion. It is actually the best predictor, better than all the economists out there. That's why the market is a bit nervous in terms of would this lead to a recession? As you can see from the chart, 1980, there was a 1991 recession. Then the year 2001 recession, you can see the yield curve inverted before the recession. Likewise, on the global financial crisis 2008. This one's a bit unique. This one is the COVID. So it didn't really invert, but of course we had recession, but no, it's not really due to, I guess not really due to growth. It's more because of the pandemic. And right now we just had the inversion, but it's just an intraday inversion for now. The most recent, the chart on the far right. Next slide. So we looked at what was the impact. So whenever there's an inversion, we are referring to monthly. So how does the stock market perform? So this is the performance of the market. Like 100 is the base, that's the index. Then 0 is the 1 means the 1 month after inversion. How does the stock market perform? Then 2 means 2 months, 3 months, 4 months until 22. So you can see most times the market still moves up. So if you look at the 12-month line, so most times the market actually does perform positively even on the 3 month and 4 months. I think we'll probably change the chart to make it easier to see, but the only time was during the .com when after 12 months the market started to correct sharply. But I guess then the market was really quite was really at really extreme levels. But anyway, so our conclusions. I mean, just looking at the past 5 recessions, the equity market only starts to weaken only like after 12 months, assuming there is a recession. And for the signals to become a recession, you usually need to get inversions for a few months. It usually not just 1 month. it's usually multiple months. Like sometimes before the recession, the inversion can be like 6 to up to 9 months of inversion. Then only you get a recession. So 1 month may not be a really strong signal. And even in June, you actually had a false inversion. That means there was 1 month in June where 98 where you actually had an inversion, but it didn't occur. And of course, we are using 10 years and versus 2 years. There's also 10 years, 3 months, which it hasn't really inverted. It's actually climbing up. And also, the Federal Reserve likes to use this forward spread. It's a very complex. It's a bit complex, but this basically refers to in 18 months' time, how do the market views the 3-month rates? But that is also not inverting. So it's not a hard signal that the recession is imminent, but it definitely does say that a slowdown is almost imminent, that there's going to be a slowdown in the US economy, at least in likely maybe, like I mentioned, the 3rd to 4th quarter of 23. Okay, next slide. Hope I didn't confuse everyone. But okay, if you look at this, I just wanted to have a quick peek at the US economy. So you can see that the chart on the left is the unemployment rate. So of course, lower the better. So you can see that it's one of the best unemployment rates, almost as comparable to the pre-pandemic lows. And if you compare to the last up to 1970, these are one of the best levels ever. So we are full employment in the US as we enter into this slowdown. But if you look at some of the more sensitive indicators, which is normally the PMI, because this one is very sensitive, you can see that it swings up and down, but it can swing down quite fast before you get a recession. So this is ultra sensitive, and of course, it will also lead to a lot of false recession calls. But you can see that there's a sharp downturn now in March because the Ukraine conflict in end Feb. So we're expecting a lot of March economic indicators to slow down sharply because of the Ukraine conflict, and we are beginning to see that in Europe and also beginning to see that in US. Next slide. So we go back to our monthly review of our model portfolio. So for the month, again, this is just an illustration. For the month, we were up about around 4%. So what dragged us down were mainly the small cap names. You can see Q&N dragged us down, Del Monte, H1Net. So all the small cap names dragged us down. The big large caps actually did well, like CDL and Keppel and so forth. Next slide. In terms of the performance by sector, what did well was shipping, but actually that's mainly because it's all about Yang Zhejiang, because Yang Zhejiang is such a huge overweight in this segment. The other things that did well was REIT hospitality, as the reopening news came up. Healthcare did poorly because I think when the repercussion of reopening means there will be less COVID-19 related revenue for the hospitals and most of the health and some of the healthcare companies like IHH and so forth. So that's why you get this weakness in the healthcare sector. The table on the right is just to show you some of the stocks that did well and so forth. So some of the gainers were Golden Energy, coal sector, APEC for some other reasons, and then Pan United for and so forth. The losers were some of the REITs, Del Monte, and so forth. In terms of the STI, actually most of the STI stocks did well. Only like Hong Kong Land, Jardine, those are the ones that dragged the performance. Okay, next slide. Okay, this is our last slide on performance. So this is just to have this is probably going to be in our strategy slide too, but we just wanted to see how how did the STI compare to other asset classes in US dollar. So the best performer was, a commodity. So if you own a commodity ETF, this is going to be the second, or after 15 months, you probably get like 60% return if you own a commodity. Because it's 1 year, 2021 is 31%, then first quarter, 3 months, 30. So you got like 60% return in 15 months for a commodity ETF. The worst is actually the bonds ETF. So likewise, that's why we're a bit cautious on stocks like Netlink, because anything that looks like a bond is going to be a bit more dangerous in terms of share price appreciation. Likewise, even for REITs that have very long WALE, so they become very bond-like in nature. Next slide. This is my last slide. This is just to run through on the SPH REITs briefing, first half results. So in terms of some of the key points, the management is very good in giving an update on retail sentiment. So that's why we always try to listen in and very brief everyone. So in terms of the reopening, they said was when dining restrictions now lifted to 10 pax is basically back to normal. I mean, you hardly get any restaurant with 12 seaters or 14, very rare, I guess. So 10 pax basically back to usual for dining, and this is important for a mall when you have dining, because once people households go to malls for dining, then you typically also lead to some, I guess, impulse purchases and so forth. So it's very important to draw in the crowd and also lead to more shopping to the malls. So dining is very important. In terms of what is happening for the retailers, of course, sentiment is more positive because of the reopening, but they're not expecting a recovery overnight. And after 2 years of weakness, a lot of the retailers are still cautious in taking up new space, and they're also cautious in raising rents. So they're not willing to like raise rents because we just reopened. Because after 2 years of, I guess, being hammered, they're a bit more cautious now. In terms of Paragon, there was a lot of discussions on the rental reversion. So Paragon rental reversions means the recent renewal was almost down 7%. They didn't really give clarity which tenants. They just said that it was better than, I don't know, a year ago, I guess. The other talking point is the increase in electricity for the malls is up about 30-40%. So there is some impact to them, but they cannot pass it on. So when electricity increases, all the common areas is all borne by the mall. The tenants only bear whatever power plug in their shop or whatever. Those are borne by the tenants, but anything apart from that, common areas and washrooms, wherever, is all aircon, everything is all borne by the malls. They cannot pass it on through higher service charge, because under the recent regime of the fair tenancy framework, they can only increase service charge at the end of the next renewal. So they can only pass it on when they go, when they enter into rental renewals. So they have to bear with the higher electricity costs. In terms of medical tourism, I think this is just some commentary. In terms of atrium, so what's happening now for most malls in the atrium, that means those common areas where you can set up booth and sell. So in the past, you can actually put up displays in the atrium, but you cannot generate revenue from it. So I guess then I guess there's no point, nobody would do it. But right now you can, because of the 29 March. Because in the past they didn't want people to linger and mingle around there. But now that you're allowed, it's for Paragon, it's not that large. It's about probably 3 million, but it's pure profit, so it's about 2% of their distributable income. I mean, this is just a back of envelope calculation. Okay, I think that's it. I think we can move on to questions. Thanks. You want to go first, Natalie?
I see some questions asking about land lease preferential offering, whether or not to subscribe for it. So based on our calculations, the first of all, the current share price is 77 cents, and the theoretical ex-rights price is 75 cents, compared to the preferential offering subscription price of 72 cents. So basically, if you subscribe at 72 cents, theoretically the shares are worth 75 cents. So it is worth subscribing. And yeah. Okay, another question about when is CapitaLand Investments ex-dividend date. The ex-dividend date is 4th of May. Yeah, 4th of May. No, sorry, wait, let me check on this again. Yeah, and there's another question asking about what is the projected percentage increase for the REITs rally and until when. So unfortunately, we don't really have a target for this. I would also like to know the answer, but yeah, no, we do not have a we do not have that much visibility to forecast or guesstimate what is the percentage increase in share price for the REITs. Okay. Yeah, let me just check back with that about the dividend, the ex-dividend date for CapitaLand. Okay, this question. Hi Natalie, if the 210-year yield inverts plus the Fed fund rates to stay above 2.5% at least for the next 2 years, plus REITs major refinancing of debt in the next 2 years, all three coincides in 2024, does that mean that REIT DPUs and share prices will slide? Any historical data to cross-reference? Okay, so generally yes, if let's say the REITs in times of rising interest rates, be it whether the REITs take floating rates or fixed rates, generally we should expect the cost of debt to increase. There is an exception, of course, which is, for example, if let's say the REIT already in their existing debt structure, their interest rates are already above the current market rates, then there is a possibility for for a lower cost of borrowing. The REITs also have, so that there is a possibility for lower cost of debt, but more likely we should expect increase in cost of borrowing as interest rates rise. So I think in general, really depending REIT to REIT, we have seen that the interest rates have actually, it's a gradual thing, because as they refinance, they don't, hopefully their debt expiries are not very lumpy, like 30% expiring in 1 year, and instead it's more like 10 to 20% expiring in 1 year. Then we could potentially see the interest rates or rather the average blended kind of effective rates to fluctuate between anywhere between 0.2% to 0.8%. That's just my guess. Yeah. Okay, we actually did a sensitivity analysis, if I can pull it up right now. Okay, so for the sensitivity analysis, based on the REITs under our coverage, given the hedge ratio that's employed for these REITs, we're actually expecting for 100% increase in rates. Sorry, not 100%, 100 basis points, which means 1% increase in interest rates. Then we expect 0.7 to 8.3% impact to DPUs for FY22 DPUs. Yeah. Yes. Okay. Okay, I see another question about land lease. So as I mentioned earlier, I think given that the subscription price of 72 cents is lower than the third price, the intrinsic or rather the theoretical express price of 75 cents, then we think that it makes sense to subscribe for your share of the rights. Okay. Okay, so another question here is, how do you see the rise in interest rates impacting REITs? Which REITs would likely be affected? Any suggestion of REITs to consider? Overall, we think that those REITs with a higher interest rate hedge would definitely be more protected from the increase in rates. Yes. Oh, give me a second. Let me try to. So for some of the REITs, generally they do employ a relatively high interest rate hedge. The likes of your CICT is 82% hedge, and in general, my slides are not cooperating with me. Yeah. Like for the REITs under our coverage, the interest rate hedge ranges between 56%. So for the Fraser family, most of their interest rate hedge is slightly lower, on the low side. Whereas for those under like Lendlease is 90%, the Manulife is about 86%, So in general, I think it really depends on also when how much of debt is expiring in the coming financial years. Yeah. Which REITs do you mention that 30% of the revenue comes from tourists? Is it Star Hill and Suntec? I think it's about generally those malls that attract more tourists. So the number is 30% of footfall that is from tourists, because in terms of tourist spend, the malls actually do not have, or rather the REITs actually do not have that information, whereas what they do track is the footfall. Yeah. As in the breakdown of footfall in terms of like tourism. Yeah. So as a general guide, around 20 to 30% of the malls, for example, located along your Orchard stretch, VivoCity for sure. Yeah. Paragon also, because a lot of the luxury products they actually benefit from I mean they're usually like purchased by the tourists. Yeah, we also expect that for yeah, okay. Another question is, I didn't quite catch why you think REITs and bonds are, okay, I think that's for Paul. Yeah, okay, I think that's all for me. I'll check back on that question about the dividend yield spread.
Thanks, Nat. I'll take some of the bank questions. I think there's two for me. Hold on, let me find the question. Okay, there's one from Freddie. Please comment on the bank sector for the next quarter. I'll just briefly comment on I would say 4 main points for the banking sector. So firstly, NIM. The NIM would remain rather flat for all the banks moving into the first quarter, as the interest rate hikes will not kick in so soon and will not affect at least the Singapore banks that soon. So it will remain flat. For the loans growth, we also assume that it would maintain at its previous quarter and the previous year, so for 2021. So it will be growing steadily at mid to high single digit. And the third one would be the the net fees, the fees income. So fees income should see a slight improvement, but maybe more in the second quarter than in the first quarter. So the first quarter would remain rather flat for the banks, the growth. And the last one would be the credit cost. I would expect the credit costs to maintain stable and improve slightly for the banks. So it will be quite a flattish growth for the first quarter. So next question is, from Adam, how will Singapore banks perform if the Fed increase the rates by 50 basis points? So by 50 basis points, I mean, all three banks have given their guidance for what will happen if the interest rates would increase. So I'll just go through quickly each bank. So for DBS, for 50 basis points, they have mentioned net interest income sensitivity of about 10%. And then for OCBC, it would be about a 9 basis. So they differ in what they would give their guidance on. So for DBS would be a net interest sensitivity of 10%. For OCBC, it would be about a 9 basis points increase in NIMs. And lastly, for UOB, they have mentioned that, sorry, give me a minute, let me pull it up. So for UOB, they mentioned a NIM sensitivity of about 8 basis points also for 50 basis points rate hike. So assuming all this, we have done our calculations and we will expect about roughly a 9% growth in the bank's PATMI based on a 50 basis points hike. Okay, sorry, there's one more question that came in. Will banks increase dividends in the next year? It's a possibility. I think I would say more so for OCBC, as their CET1 ratio is still the highest. So as you know, UOB and DBS, they're both sort of spend their capital on acquisition, the Citibanks, to acquire Citibank's assets. And DBS especially with they had their MAS the MAS extra fine or something. Yeah, I can't remember the word, exact word is missing. I can't find it now. Yeah, but so DBS's and UOB's CT1 ratio has lowered slightly, but OCBC's one is still quite high. So for OCBC, I would say there is definitely a potential increased dividends. I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Yeah, I'll take the next few questions. Just clear some of the questions on the queue. We have one question. Is KIT a competitor to Union Gas in the business of gas supply? Yeah, so yes, for the city gas business, they are competitor to Union Gas. Hi Terence, did KIT share how they intend to increase DPU going forward and how to fund it? So there are two questions to this. I'll take the first. So in terms of how to increase their DPU going forward, what they're going to do is they're going to change their business model to a core plus business model. This means in the past, how KIT do the acquisition of their business is they look for businesses that generally give a fixed cash flow, similar to the waste and water business and their energy business. So every year they just get paid a fixed amount, and then they just disperse this to shareholders. But going forward, they intend to change it to a core plus business model. So a core plus business model means that they still look for business that give a steady stream of income, but also have a growth upside. So this growth upside will give them the increase in DPU going forward. And that's where they get the performance fee. So these are the type of acquisitions that the management would incentivize to fund going forward. In terms of how to fund, it will be a mixture of internal funding and also external, but they didn't elaborate more on external funding. But one thing they did say is, especially with their focus on ESG, they have access to green loans and sustainable loan financing as well. So those can help to finance the acquisitions going forward. Any target price for KIT? No, so we don't cover KIT. I think in our presentation just now, we mentioned KIT is a part of our coverage under Phillip on the ground. So those we provide because we attend the briefing. So we just share the findings from the briefing. What will be the feature of SPH after this week? Is that advisable to sell or keep it? So I'll take this question first. For SPH, they've already obtained court sanction. The High Court has already sanctioned the deal. The last trading day for SPH is the 7th of April. So that's Thursday. Is the last trading day. After that, you cannot trade SPH already. So if you want to make any action after doing your own due diligence, you have to do it before Thursday. Shareholders of SPH will then have to elect by the 26th of April whether they want to get an all cash consideration or they want to get the second option, which is the cash plus SPH REIT units by the 26th of April. And then they expect the payment to be sometime in May, early May, and then the whole shares of SPH will be delisted by 13th of May. So is it advisable to sell or keep it? Yeah, this one we cannot advise you because now it's trading about $2.35 and $2.36. So if you choose to sell now, then you incur brokerage, and it's based on your own financial objectives. But if you choose to sell now, then you incur the financial brokerage that when you choose to sell. But if you choose to tender, if you choose the option, you tender the shares to SPH, you don't have to incur the brokerage. But then you need to wait about a month for the money to come in. So it depends on which one is more important for you. Is it that SPH is different and move to that? This one maybe I leave for Paul to answer. So I leave the question here. Any views on SIA engineering? Yeah, so I don't know if Paul want to weigh in, but I'll probably weigh in a little bit of this question also. For the Changi Airport statistics that have come out for the first 2 months of 2022, the travel throughput at Changi Airport is already 45% that of 2021's level. So you can see the strong recovery. It means for just January and February, March, we don't have the numbers yet, but for January and February alone, it's nearly half of the total number in 2021. So this is, we are seeing a very strong recovery in the air travel sector, especially in the first 2 months. And the forward indication from some of these players, from SIA and also SETS, is that they are actually doing major hiring now to try to hire a lot of the staff that to fill the positions because of the volume that they are seeing going forward. So SIA engineering is also benefiting from the recovery in travel. Overall, the numbers is still 10%. If we look at the first 2 months alone, it's just 10% of pre-COVID level. So still a long way to go, but the recovery is there. I don't know if Paul have anything to add, so let's leave the question here as well. Hi, Terence, what's your opinion on the 2 options for SPH? Which one is better? So it's difficult to say which one is better because the first option, which is the all cash option of $2.36, is a very clean option. So it depends on your investment objective. If you want value certainty in the option, then $2.36 is very clear. You just get a cash amount. But if you think that there's upside for SPH, then you think that there's some growth in the future, and you want some yield, then the second option may be better for you. So yeah, no one good option. Yeah, really depends on your own objective. I think that's all for me. I'll hand over the time to the rest of my colleagues.
Okay, yeah, thanks, Terence. Let me just try to answer this. Okay, I don't cover Yang Zhejiang, okay, but let me just read this out. Any views and target price for Yang Zhejiang spin-off? Also on the take for possible price movements, short and long term before and after the spin-off. The other question is, hi, what are your views on Yang Zhejiang's stellar performance? Do you think it is sustainable? Okay, let me just give you my views, and let me just change the background setting. Sorry, it's from the conference yesterday. Okay, yeah, sorry for that. Okay, we just to give you some there's no briefing given, so if they give briefing, we'll definitely let everyone know. So Yang Zhejiang is worth 6 billion. They're going to spin off their financial arm, come hedge fund, come loan company or banking mini-me company for 4 billion. But the issues I have, they were spinning off, and the shareholders of Yang Zhejiang will get shares into this financial arm. The issue I have is just that you know, the banks in China, the 4 billion is NTA. The banks in China trade at, I don't know, 0.4 times or 0.5 times price to book. So I'm just worried, how is Yang Zhejiang going to trade much higher than that, or could it be trading below book? So I'm not sure how much can you, how much valuations above NTA can you get if the banks are only trading at 0.4, 0.5 times in China? Unless you spin some fintech story, then you're gonna put any price to NTA you wish. So that's my one worry. Again, I don't cover, so I'm not sure. This is just my own views. And number two, of course, the good thing about dividend specie is that you get the shares. Everybody gets the shares. All Yang Zhejiang shareholders get the shares. But the downside to it is also because everybody also gets the shares. So everybody's having the same cost, and everyone might be saying if their price is above the Yang Zhejiang, the current Yang Zhejiang shares, because you're going to get the old Yang Zhejiang share price will drop, and then you're going to get free Yang Zhejiang financial shares. Right? So I'm not sure if there's such a huge float. I'm not sure how much can the Yang Zhejiang financial shares stand, because everyone might be selling to take profit. So again, this is just my own views, and just take it with a pinch, a whole lot of salt with it, a pinch of salt with it, or a bucket of salt with it. So I do not know the details. I do not know what's the valuation, but in China, the banks are trading so cheap, so I'm not sure how much further can this valuation, because the banks' valuations might be pulling it down. That's my only worry. Okay, could the weekly email sent to registrations on this webinar be updated with the new link? Yeah, okay, we will work on it. Yeah, sorry, I think we had some issues with the new link, so we will try and get someone to try and fix that. Will the materials be shared with participants? Yeah, you send us an email and then we will give you the PDF version of it. Yeah, just send in an email to any one of us and we'll send it to you. Any possibility of stagflation? If yes, when do you think that would occur, and what parameters do you look out for such occurrence? Okay, just for those who do not know, stagflation basically means high inflation and slow growth or negative growth. Basically means in layman terms, everything became expensive, but my income dropped. So I mean, it's like the worst of everything. So for us, in actually Singapore market, we think is a stagflation shelter. Why we say that is that in this rising environment, the banks, including the stock exchange, is almost 50% of the index. So they are going to be the big winner from rising interest rates. And then, of course, you also want to placate against slower growth, but Singapore has the added kicker because of the reopening. Tourism is 5% of our GDP. And 5% is very big for Singapore. I mean, because Singapore, our growth rate is maybe 2-3% pre-pandemic. So when you get a 5% kicker for the next 2 years, or I guess for this year and next year, then we think Singapore stocks it will be a shelter for stagflation. So this is what we think. I don't think we are entering a stagflation because we need to see like negative growth, I guess if you want to define it. And we don't think it's going to happen this year because global economies are still strong. Just that you will see a growth deceleration. It doesn't mean a contraction in global growth. Yeah, and 25% we did account is probably in our strategy piece too. 50% of the index is banks and 25% of the index is related to reopening place. Hospitality, even telcos we consider as hospitality, as a reopening play. We did account, I think StarHub, roaming revenue is as much as 50% of StarHub's profit pre-pandemic. So if roaming returns, StarHub can get this big, huge jump in earnings because roaming revenue is pure profit. There's no cost. So although it's 15% of mobile revenue, but it's, I don't know, 50% of StarHub's profit. So we think Singapore should do well in this stagflationary environment, I guess. Okay, when 10-2-year US Treasury inverts, equity market will weaken after 12 months. Are there any specific sectors that will perform worse or better? Yeah, that's a very good question. We just don't have the time, but give us some time. We will try to because when you do sector means there's a lot of heavy number crunching to do. Yeah, because we have to pull out all the various indexes. We will try to get something and see how it's performed rather than try to speculate and guess. Yeah, we will try backtrack and see what, because you got like financial commodities, whether all these sectors do well. During the last few inversions, we will focus more on the US sectors, but we will try our best to get it for you. Or maybe I'll ask someone to do it. But anyway. Yeah. S&P Global downgrade ST Engineering to AA. Should I hold the stock? I'm not sure if Terence want to do, but we think defense, the defense should be a really good industry to be in. Because after the Ukraine conflict, what it actually means is there's going to be an arms race. Because when Germany increased their defense budget to 100 billion, then the neighbor will look, all the neighboring countries will also look and say, "Oh, Germany raised the defense so much." But I too will try. Everybody will try and one up each other. Likewise, for this region, I can only imagine if any country in the region raised their defense budget, the neighbor also will want to raise. I mean, this is not a pleasant thing. I mean, better that the money go for education, healthcare, but because of the Ukraine, one repercussion is everybody just trying to outdo each other, like who can spend more on defense. So that's a worrying trend. My own views, Terence follows it closer, but I think ST Engineering looks attractive in this because of the defense budget. Okay, the rest is Natalie. Okay, I didn't quite catch why you think REITs and bonds are dangerous in the yield. Okay, what we were trying to say is that when interest rates rise, not so much yield curve, but when interest rates rise, bonds will get hit the most, and any REIT that look like a bond would get hit the most. That's what I mean. And what are the REITs that look like a bond? Will be REITs that cannot grow. And they cannot grow normally if their will is long term. So it used to be if you have a long will, everybody love you because your dividend stability. So maybe stability is not the issue now. The issue is can you grow or not, because interest rates are rising. Can you rise faster than the increase in interest rates? So that's what we mean. So long will is in a way could be a negative. I mean, yeah, because you're stuck, right? You cannot raise rents. Again, just a thematic. Hi, Paul, your question mentioned the likelihood of SIA engineering privatization. Do you still hold this view? Is acquisition by who? Okay, all this privatization, again, this is like 90% guesswork, but it only makes sense because ST Engineering has a commercial aerospace division that does almost the same with SIA Engineering. And the good thing about SIA, okay, that's number one. So they all share, the Temasek is doing this huge global champions, right? Temasek wants to only grow global champions. If you're not global champion, he probably sell you. I'm just guessing. So by merging, then you can become global champions. So commercial aerospace is 2 billion for ST Engineering and 1 billion for SIA. So it only makes sense, so you can grow, you can scale. The other good thing about, of course, SI Engineering is not so much revenue, it's a lot of it through associates, so revenue should not be the best comparison. But so that's number one, as they push for global champions. Number two is also SI Engineering is quite tightly held. So SI Engineering is 77% owned by SIA. So it makes it a bit easier to I guess, privatize it if they wish to. Of course, I'm not sure how at the current conditions, SIA's balance sheet, I'm not sure how soon it will be, but that was our initial thoughts that if you want global champions, and then this is the easy one because the float is only like 20 plus percent, 23%. So if we thought it was an easier way to acquire. Again, privatization is all like guesswork. I'm not sure when the timing is all. You get the timing wrong, you get it wrong. So we're not very sure. Yeah. Is Olam a better commodity stock to invest going forward than Wilmar? I would, my own, again, we don't cover this. My own view is probably so. Because my worry for Wilmar is the consumer business, like we highlighted before. That one, they're facing a lot of margin pressure. And also, Wilmar soybean crushing business is facing a lot of margin pressure because the hog prices there are coming off. So I think, and Olam could get, like I said, there's this, like we discussed last week, there's this listing in the UK which could be more than a market cap, but that may not happen so soon. Yeah. Okay, I tried to answer some I really not sure how to answer. Any concern with Russia asking for payments of oil and gas to be in rubles rather than US dollar? Yeah, the first thing is that these gas agreements are like, I don't know, multi-year. It's really all there's a lot legal. It's really protected by law, but now they want to change the goalposts. So I guess the worry is that if they don't do, then Russia use this as an excuse to shut off the oil and gas supply to Europe. Then this would cause oil prices to spike up and makes the whole global growth environment even more troublesome. So there's definitely concerns, especially if Russia uses this as an excuse to shut off oil and gas supply to Europe. Yeah, again, this is just my own thoughts. Any comment on ComfortDelGro? Yeah, we still like ComfortDelGro. It's like almost 40% below pre-pandemic, and we also noticed that because the taxi might actually do better in the current high price environment than the private hire cars, because most of ComfortDelGro's cars are all hybrid. So they have a competitive advantage, I guess, right now compared to, I don't know, a Grab or a Gojek, I guess. Yeah. So no change in our views. And always remember the last 2 years, even though we had the worst pandemic, ComfortDelGro generated free cash flow of almost 900 million. So that's why we're coming out of the pandemic stronger. Yeah. It's just that there's no earnings momentum. So that's why no one will buy. No, there's no earnings momentum. So that's why the stock has been an underperformer. And I think even the first quarter, you won't get a big jump in earnings because of the reopening only happened end of March. So the first quarter might still be a bit sluggish because when you look at the latest transport data, the real data, there hasn't been a real spike. But taxi might be better because they will not give so much rebates because they were giving discounts. They used to collect $120 per taxi per day. Then they give rebate of $60, which is pure profit. So we think that will narrow and that should help improve performance. But you won't get a really sharp earnings recovery until hopefully in the second quarter, we think. Okay, I think I'll hand it back to Natalie. Yeah. Okay, let me answer this before I hand it to Natalie. Hi, Paul, can you explain again on the last statement of 10-year, 3 months and forward spread not inverting? I missed this. Okay. When we look at yield curve inversion, the whole objective is because they are one of the best, like I said, best predictors of recession. But so you can do a 10-year to 5-year, some do 30 years. You can do, it's like whatever poison you like. But some of those, like they do the 10 to 3 years, that is not inverting. That is actually instead of coming down, the chart is actually climbing up. So that doesn't really, those who follow those would say that no, it's not confirmation that there's a recession coming up. That's what we meant. Forward spread is something that if you go in Google or whatever, it's something that the Fed economists did a study and they said that the forward spread is a better indicator. But I'm not too sure about that. Yeah, but anyway, that is also not inverting. That's not coming down. That's climbing up. Yeah. So the other indicators doesn't support, the other yield curves doesn't support a recession call. I guess that's the point. Yeah.
Hello.
Okay.
Hi. Okay, so I was trying to find out when is CapitaLand Investment Limited's ex-dividend and payout date. However, I have not been able to pin down that the date. If you look at CapitaLand, the previous demerged entity before it went for this demerger and became CLI. So for CapitaLand, in the past, their ex-dividend date was around late April to early May. So I think that's the best guess that we have right now. Yeah. And for the payment date actually it ranges. I think it's largely in May. Yeah. Okay. Another question here is, has the hospitality REIT and trust priced in the recovery? Thanks. So I think in our view, the recovery is largely priced in. So for hospitality REITs, they are currently trading about 24% below pre-pandemic levels. Apart from that, in terms of dividends, we think that the dividends, we only cover Escort, but based on the consensus dividends, when we look across the hospitality sector, most of them, they are actually in FY22, they will only be posting between 50 to about 76% of, or rather 50 to 70% of 2019 dividend level. That means in terms of cents or dollars. And then in 2023, the DPU payout in cents is expected to be around 70 to about 80% of pre-pandemic levels. So meaning to say that in the next 2 years, dividends are not expected to recover back to pre-pandemic levels. But yet I think how the REITs have the share price of the REITs, it has recovered slightly. When we look at towards the end of 2021, coming into right now. Yeah. So just let me double check this. Oh yeah, sorry. Yeah, so actually they've been relatively flat still, about 24% down from pre-pandemic levels. So in terms of dividend yield, the forward dividend yield for the hospitality sector for FY22 is approximately about 6%. Given the current price levels, I think historically at this price level, the dividend yield should be around 7-ish%, 7.5 on it. Yeah, so I think long story short is that we think that given the the very protracted kind of recovery timeline, it might not be the right time to go into hospitality just yet, but also bearing in mind that we actually do like Ascott Residence Trust quite a lot. Given how they have been pivoting their portfolio, towards tourism, be it corporate or leisure-driven tourism, towards more of extended stay kind of assets, which are your student accommodation assets, as well as your rental housing assets. And these kind of assets, they have maintained occupancy levels above 95% during the pandemic, as well as long average length of stays, around a year or more. So the pivot, the shift of moving their portfolio, they aim to actually have about 20 to 25% in these extended stay assets. So this will help to add stability for the portfolio. And currently the percentage of AUM in these extended stay assets is 16%. So I guess that it just implies that they have been quite active in terms of acquisition in 2021 and also in the early part of this year, and that just means that we should be expecting more acquisitions from Ascott. There's a question asking about how to subscribe for REIT preferential offering. I'm afraid I'm not the best person to ask with regard to this. Please reach out to your trading representative. Yeah. Okay. In view of the ongoing MNEC and MCT deal, will the price of these two REITs get stuck at the current levels, even if the general REIT market were to continue improving in the future? I think for MNEC, the prices will depend very much on how MCT is trading. Also, do recall that there is actually a cash offer on the table. So the currently whatever share price they're trading, I think at the time it was 222. Was it 122? That was already above what the cash offer was of 1.1949. Because the market was already factoring in some dividends, or rather the accrued dividends for the quarter, for the half year ended 31st March 2022. Yeah. So I mean, if MNEC's performance, coming for 31st March, for the half ended 31st March, were to be very above expectations, then we could see the share price increasing to factor in these accrued dividends. But apart from that, we think that MNEC's performance will very much be tied to MCT's performance because of this exchange ratio. Yeah. So if MCT shares were to, I think MCT shares in general is not really fixed to anything, but it could improve if the portfolio recovers faster, which, as we mentioned, I think because of what their one of their major assets, which is VivoCity, that is the mall itself will experience a lagged recovery due to its reliance on tourist spending. Yeah. Do you have any visibility on IPO schedule for Mapletree PBSA as REIT? Student accommodation REIT, basically. Unfortunately, no, we do not have any visibility on the IPO schedule. In fact, I think it has been relatively quiet. So yeah, not really sure what's going on there. Yeah, okay. Okay, I'm just scrolling through the questions right now. Okay, I think that's all the questions for me.
Yeah, I think some of the other questions in the queue. S&P Global downgrades ST Engineering to AA plus. Should I hold the stock? So the rationale for the downgrade for ST Engineering was because they took on a significant amount of debt to fund their TransCore acquisition. It's unrelated to ST Engineering's inability to pay the debt. So I don't know if that's a concern, but the reason why they pushed their gearing up is because they wanted to acquire TransCore, and the current gearing level is still within management's accepted gearing range. So it's not out of line with their historical gearing guidance. We don't have any coverage on ST Engineering, so we cannot tell you whether you should hold. But in terms of, we can comment on the outlook. Their order book is at $16.9 billion. So that's a 5-year high. The rest of their business segments are performing well. The business that was impacted the most during COVID was the airline commercial business. And that, in our latest meeting with them, they talk about the strong recovery in the commercial business segment. So even the guard business has also improved for the group. For ST Engineering also to signal their confidence in their future outlook, what they did was to change their dividend payment frequency from twice a year to 4 times, and they increased their dividend from 15 cents to 16 cents going forward. So that I think signals their confidence that they'll be able to continue paying dividends, and they were actually paying dividends during the COVID years as well, financial year 2020 and 2021, and now they're going to increase the dividend. So we don't see this downgrade, even though they downgraded it, but in the announcement for S&P Global, they still rated it as stable. So we are not overly concerned with this downgrade of ST. SETS has ventured into some new business not too long ago. What is the impact, positive or neutral? So you're right. What SETS did was to one of the main things that they did was they have 2 main business segments: the food business, and that food business is where they supply the catering food to the airlines, and then the second is the gateway business segment. The gateway business segment takes care of the traffic and the logistics at Changi Airport. So the area that they venture into is the new food segment, and what they do is to split that segment up into 2 main business segments. The first is aviation, and the second is non-aviation. So what they're trying to do is to rely less on aviation. Pre-COVID, that segment, the aviation segment, was 90% of SET's food revenue. What they're trying to do, their 2026 target, under their 5-year plan, their 2026 target is to move that 90% to 60%. And non-aviation will be 40% of revenue. For us, the impact is positive because that means that they will reduce their reliance on just travel alone in the food segment and increase the weighting on the non-travel. So reducing the impact on earnings if there's any travel shutdown. Now, I think that's all for me. I'll hand back the time to the rest of my colleagues.
Okay, let me just try and wrap up as much as I can. If I recall it correctly, the variance between S&P 500 and 10-year Treasury is 2% in favor of the former. This means fund managers will shift their funds away from equities if the variance is less. Okay. Variance between, I guess you're referring to dividend yield versus Treasury. It really depends because do know that if interest rates are rising, then a fund manager wouldn't want to hold bonds. So you might get the flow. So if you know your bond portfolio is going to get hurt badly, right? Because interest rates are rising, the flow might benefit equities. So it's not just the absolute number, but in the near term, as you know, bonds are will come off. So the flow might go into equity. So that could be the other reason why the variance might be coming off for now. Yeah, I think this might be maybe when interest rates are more stable, then maybe the variance could go back to mean. I think that is the answer, and likewise that is probably the question on this. Any views on gold, please? So likewise for gold, we like I highlighted before that the tailwind for gold is because investors don't want to hold bonds because they know they're going to get hurt. So there might be a shift in flow from bonds into gold, just as a hedge. I guess that's the purpose, right? As a hedge, as bonds get sold down and bond prices weaken. So that was number one. And number two, gold might still have a hedge value because if the Ukraine conflict is still there. But again, all this is again a lot of guesswork. So my own thoughts is, yeah, maybe there's still some value to gold right now because interest rates are still climbing up, and so nobody wants to get caught with holding bonds. Number one, and number two is with the Ukraine conflict now. Again, if really you're just hedging against Russia stopping gas to Europe. I mean, if that happens, then I think people will just jump to gold. Again, this is like 90% guesswork again. Okay. For air travel, which is the better buy, SIA engine or sets or any of the others? For us, if I think we also had this similar question. For us, SIA is a bit worrying because the book value is actually we were discussing it that day, could be $7+ to $3 depending on how the mandatory. So it could be overvalued at these levels on a price to book basis, and you also have to worry about fuel prices. The one that of course, then SIA engineering should recover, and there's also possibility of privatization. Again, this is all just, it doesn't mean it's going to happen overnight, but it's just that we thought that the layout is conducive for privatization. Maybe not now, but maybe later, because when SIA gets balance sheet could be stronger. Then they can merge with ST's aerospace. Maybe SETS should be the better, like we said. Now SETS has the closest to the model has the closest to an airport. Because their market share is so high in Changi, probably 80-90% market share. Any plane that come into Changi is theirs. I mean, so just as a reminder, SETS will go in to clean the plane, to feed the plane, to feed the passengers, and so we thought that would be a good way to play the recovery and an easier way, because there's no competition. You don't have to worry about Middle Eastern airlines, low cost carriers, and you are almost a pseudo airport in terms of the barriers to entry. In Changi, I guess. Yeah. So that we thought SETS could be a better way to so you don't have to go easier way. You don't have to think so many variables. You don't have to worry about fuel price and competition, how other airlines cut prices and all that. Yeah. Do you think Burma will have positive growth in the current world environment and war? What's the outcome when the war ends? Oh, this one is very tough. I'm not sure how to answer this one. If the war ends, maybe it could hurt palm oil prices. The difficulty for Wilmar is because they are very diversified. So theirs is the most stable goal. One segment might do well because commodities. One segment might do worse because commodities. So there's no really hard answer for that. So for Wilmar, you really just have to take a longer term view because they are very diversified. Yeah, their plantations will do well if commodity prices are up. Their consumer won't do well because they cannot pass it on. So these are like because very sensitive to do it in China. So so I'm not really sure how to answer that. Sorry. this means that if a 2-year, 10-year yield is 2%, then the S&P must generate 4% or higher dividends to induce fund manager to switch. Oh, that was the earlier question. That may be so, but not now. Now you like I said, the flows from bond investors into equity would placate that. So reverting back to the mean might happen, but maybe not so soon. Yeah. Could a Chinese bank over-report their book value so their price to book looks attractive? I mean, I don't want to say anything about the Chinese banks, but I guess if you trade so cheap, then maybe people are concerned about your provisioning. I guess in a way you are right too. They are a bit concerned that you're not providing enough NPLs on your books. I guess that's the most diplomatic answer. But having said that, how do we know about Yang Zhejiang's books? I mean, yeah. Like unless we have like better clarity in their books, I guess. Hi Paul, with the STI above 3004, is there room for further upside? We still think there is. Although we all know that the banks will benefit from rising interest rates, it is extremely hard to forecast. Even Glenn can forecast it well, but even then, there's still a lot of moving parts. Because firstly, even when the Fed raises rate, you're not sure the correlation. That means the Fed raised rates, but how much would that impact local rates? I mean, the correlation can be 0.7, 0.9, depending which year you calculate it. But so the transmission from the US interest rates to local interest rates is not. It is high, but it's not like foolproof high. So that's number one. Number two, the transmission of higher rates to higher profits, it also depends on, so a bit technical, but a bit on CASA ratios. It depends on competition. Yeah. So that's why we think it would still surprise the market. So it's not like a 1-for-1 or interest rate so much, but you can estimate, but you can't like have a strong. So people might still be a bit hesitant in terms of how much upside in terms of banks, but we think banks will lead the way, and the whole reopening, like we mentioned earlier, that can help drive the STI up. Hi Paul, what are your best buys in second? Yeah, I think our strategy report will be coming up later at 3 p.m. So I think I think that will probably help answer some of the questions. Yeah, and we'll probably discuss more of it on Saturday in our strategy event. Any price target for Singtel and StarHub? Yeah, what's the okay for StarHub is 135. We are not aggressive on StarHub's target price because the borders have not reopened. So a lot of the analysts and market will probably be a bit lag in terms of upgrading because the reopening hasn't happened. Now that it's happened, then maybe there could be more room for investors, for the analysts to maybe revise upwards for roaming revenue. Because it was very hard for us to forecast roaming revenue when the borders were still closed. Because the investor can always ask, oh, so how do you know roaming is coming? I have no idea, but right now there's better visibility. Yeah. Okay, and roaming is more important now because right now if you go to you go to Malaysia or wherever, you definitely need a data plan. Otherwise you cannot travel. Even when you come to Singapore, if you don't have a trace together, you don't have any data plan. In the past, travelers can go around countries without data plan. They just use the Wi-Fi there, but that's not going to happen these days. You're not going to get entrance to anywhere if you don't have a app, especially like those trace together apps and so forth. Yeah, so there'll be a higher proportion of roaming sensitivity for travelers that come here or go overseas. Yeah, we think, I mean, that's our opinion. Okay, well, this any revision to your target price for Thai beverage in light of the Thai reopening? Yeah, your estimate is pretty downbeat. We still have a accumulate call on Thai bev. Yeah, we downgraded was mainly because of the Thai baht, because the Thai baht depreciated 10%. Yeah. So that was mainly it. Yeah, but it's definitely a recovery because last year shut down, this year open. So no change in our view right now. We'll just wait for the results. Yeah. Okay. Still got okay. Paul, what is causing the inversion? Why would 2-year interest be higher than? Yeah, that's quite strange. Right? Why? Okay, but I mean that's a fair question. It's basically expectations that growth was slow. That's why interest rates cannot. So basically, they think that 2-year interest rate is here, but 10-year will come down because they think that growth will slow down and interest rates will collapse. Yeah, so that's the reason. It's more expectations. It's more like investors, and Treasury is one of the biggest. Of course, some can say it's being distorted by the Fed, but it was also distorted by the Fed in 2020, but it was still a very good indicator then. Besides Beerco IPO, yeah, we did some calculations before. We don't think Beerco IPO is going to impact Thai Bear's earnings per share that much. Our from memory is probably 3% or 3% plus, depending on valuations. Yeah. Because I think they're asking for, I don't know, 30, 40 times type of PE, which I'm not sure whether the market can stomach it. Beerco refers to Thai Beverage IPO their stake in Sabeco and their domestic beer. Yeah, it's mainly to de-gear because they borrow a lot to acquire Sabeco. Sabeco, sorry for those who don't know, is the largest largest brewer in Vietnam that Thai Beverage bought. Which semiconductor shares would you recommend? Still UMS and AEM. I think this year the results should still be strong. Okay, the rest is all Natalie. Where do we get a replay of this episode? We will record it and put it into YouTube, our PhillipCapital channel. So all the previous recordings, which is almost an hour. So yeah, it's all there. Yeah. Yeah, where can I get a watch? Yeah, sorry. The replay is in YouTube, PhillipCapital. Okay. I think the rest is Natalie. I'm not sure if you want to take it.
Okay, so I'll take the easy question first. Is MCT offer for MNEC low, fair, or high? If it's low, why isn't there any new bidders? So the first half of the question I can answer, but the second half I can't because I cannot answer to why there's no new bidders. But there have been some activist shareholders that think that the price for MNEC offered for MNEC is low because the 1.1949 price tag was actually fixed on 1 times NAV of 1 times price to NAV of MNEC as of 30th September 2021. And since then, there has been a recovery in the NAV of MNEC. So meaning to say right now, this 1.1949 is actually below 1 times price to NAV of MNEC's price to NAV, but then the offer price has already been fixed at 1.1949. Yeah, so I think that is where some of the unhappiness from unit holders, some unit holders comes from. But clearly from the all cash offer announcement or amendment just last month, we saw the share price rally. So I think majority of shareholders are now reacting more positively to this offer because as a 100% cash offer, then I mean the option for 100% cash payout or consideration just removes the price uncertainty of MNEC trading very closely to how MCT trades. So as to why there's no new bidder, I cannot speak for the other entities out there who are not bidding for this for MNEC. Yeah. But I think it was addressed in one of the calls that MNEC did not receive any offer since the time of the announcement of the merger, which is 31st December. But if they did receive any offer, then they definitely would consider it. Yeah, but there's no offer and we don't know why. Okay. 2 questions on ALOC. Please comment on ALOC price post-merger with ESR next month. So once the merger is completed, the units will be, or rather the new entity will be ELOC, being I think ESR Logistics. So then there will not be any ALOC, but just yeah. So we do not have coverage on both of these counters, so we cannot comment on the price. Another question is, will ALOC pay dividends for January to March 2022? Yeah, I believe that there will be cleanup dividends that will be announced. Yeah, I think yes, for both the ESR and the ALOC unit holders, I think there will be a cleanup dividends just so that when the merged entity, when the entities are merged, then it will start off on a clean slate. Another question about land lease REIT. and the rights issue, is it worth buying? So I think I mentioned this earlier, but perhaps you missed it. So for Lendlease, once again, the share price currently is 77 cents, and the preferential offering price is 72 cents. So this 72 cents is below, is cheaper than the theoretical extract price of 75 cents. So technically you should if you don't mind increasing your exposure to Lendlease, then you should subscribe for this this preferential offering, just given the fact that you're able to get a better entry price compared to the market and also compared to the TERP. So I think that's all for the questions we have right now. I'll pass time back to Paul to bring the session to a close.
Yeah, thanks. We had some questions on the chat group. Yeah, sorry we missed it because we usually just want to consolidate them all on the Q&A. But one question was where to rename my name, please. I want to use short name. Yeah, I think you can change it. On the right, there's a small dot button that can change your name. If you can't, then I guess it's because your registration, they will stick your name based on the registration name. So I don't think you can change it unless you want to re-register, I think. Okay, last one, any view on long-term commodities with inflation running up commodities? Again, commodity is so wide. I guess you have to look for commodities that where supply has been severely impacted, or commodities where there has been new demand. Because if you're expecting growth to slow down, then commodities demand is going to be impacted. So for us, coal actually look interesting, because even the German chancellor said that he needs to stockpile on coal. That's because they cannot rely on Russia, number one, and number two, because renewables is so volatile. And renewables all depends on the weather. So if you look at UK's renewable generation down 15%, which is huge. I mean, imagine how are you going to rely on something where in Singapore, power generation only goes one way up. So imagine if it comes down, how are you going to? I think there was a comment from Albania that their renewables was down 50%. So imagine if your power generation down 50%, how are you going to cope with it? So as a result, coal is going to get new demand from Germany. But anyway, yeah. Anyway, for commodities, have to be a bit more selective because, like I said, they did run up 60% the last 15 months. So just have to be a bit more wary which commodities you're buying. But anyway, because it's already 1 o'clock, so I'd like to thank everyone for your time and especially your questions. And if we miss any, apologies. And hope to see you in our strategy this coming Saturday or the following Monday, 11:15. So thank you everybody for your time and for your questions. Bye bye.